Since May 2019, it is for the first time that the Indian banking system is witnessing a deficit. Hello and welcome to the In Focus series section of Drishti IAS. I am 𝐈𝐀𝐒 Singh, and in today's video we will be discussing everything about the banking system liquidity deficit which the Indian banking system is experiencing at present. So now let us look at the timeline of the video, what all we will be studying. First we will be looking at the news, then about the multiple factors which has led to the deficit in the banking system, then about the banking system liquidity, what is banking system liquidity, then the latest RBI data which it has been given, and then the tight liquidity condition, what is tight liquidity condition, and then what can the RBI do in it. In the end we will be looking into a prelims MCQ and a mains practice question. This topic is of relevance from General Studies paper 3 economy. See, from exam perspective you should be able to know that what are the factors which are leading to the deficit in the banking system, and what is tight liquidity condition, and what can the RBI do in it. So now let us look at the news, and this news has been taken from the Indian Express, and it says, what banking system liquidity going into deficit mode means. So there are two basic components in this. First is banking system liquidity. What is the meaning of liquidity? And second is the deficit mode. So first let's see that what is the news. See, recently what we have witnessing is that the banking system liquidity situation has turned into a deficit mode. Okay, what is the meaning of the word deficit? Deficit means when we are lacking something, that there is a lack of something. Like for example, you need 10 rupees to buy something, and in your pocket you only have rupees 5. So you need 5 more rupees to buy that thing. It means you have a deficit of 5 rupees. So deficit means when you are lacking something. So it means that the Indian banking system liquidity is not up to the mark. So what we have seen that if on September 2022, that is rupees 21,873 crore rupees deficit can be seen. While on the other hand, in November 2021, it was seen that the liquidity surplus was of 8 lakh rupees, because at this point of time, the RBI was pumping money into the economy to recover economy, or to bring back the economy on road after the COVID, and the COVID recovery was going on. So the Reserve Bank of India was providing liquidity support to the economy. But now at present, now because the things are becoming normal and the things getting back into the same line, the RBI no more is pumping money, or has reduced pumping money as compared to earlier times. So that is not the primary reason of the deficit, but that can be one of the reasons of the deficit. But the core idea is that the Indian banking system is experiencing a deficit of 21,873.4 crore rupees. So what is the multiple factors which has been attributed towards this deficit? First is uptick in the bank credit. So recently what we are seeing is that now the people are coming back to the banking system to borrow money from the bank, and the banking system are also lending a lot of money to the people, because the economic conditions are becoming normal and are getting back on road. And second is the advance tax payments by corporates. Okay, what is the meaning of advance tax payments? See, what is the meaning of the word advance? Advance means you do something which in advance. It means before that date. Like for example, you have to pay the tax at the end of the year, while on this in some situations there are quarterly payment of taxes. So that is why you pay advance taxes before the date you pay the tax. So what happens when advance tax is there? Like for example, take the example of TDS. For example, if someone is working in a company, 10% TDS is cut. So for example, a person has a salary of 50,000 rupees and he is getting in hand, that is 45,000 rupees. So 5k TDS is cut on the basis of 10%. So what is that 5,000 happens? So every month that 5,000 rupees gets cut on the basis of the TDS, and at the end we file the income tax returns. So that amount of the TDS comes back to the account of the person, in the account of the person. So same basis, advance tax payment which the government receives from the corporate, government cannot use the full amount that they receive from the corporate in the form of the advance taxes, because they have to return back some of its money in the end. Then the incremental deposit growth not keeping pace with credit demand. This is one of the major reasons that credit demand is more than credit deposit. See, the money going out is more than what is the money coming in. It means the receipts is less than the expenditure. So incremental deposit growth not keeping pace with credit demand. Like for example, in a house, if you have earning of rupees 10,000 but you have an expenditure of 15,000, then how will you manage? It means you are spending more than what you are earning or what you are taking in. So this becomes a problem when your spending is more than your earning. Then also the intervention of the RBI to protect the rupee against the US dollar. Recently what we are seeing is that the US dollar is rising high as compared to all the other currencies in the world, and same is the case with rupee also. At present, if I'm not wrong, that the dollar price is around 79 to 80 rupees. So that becomes a huge gap between dollar and rupee, and the RBI is trying its level best to close that gap and make that gap as small as they can. So these are few of the multiple factors which are leading to the deficit in the Indian liquidity market, Indian banking liquidity market. Uptick in the bank credit, people are taking more money from the banks, advance tax payment by corporate because the government cannot spend all the money that they receive in the form of tax. Then incremental deposit growth not keeping with the credit demand. Demand is high while the receipts are less. Then RBI is also trying to protect the rupee against the dollar. Now let us look at the banking system liquidity. What is banking system liquidity? First, let us know what is the meaning of the word liquidity. What does liquidity mean? Okay, I'll again tell you in an example. Like for example, you want to buy something and that thing is of 5 rupees. And you have only 2 rupees in your pocket. So how will you buy that thing? You will not be able to buy that thing because you are short of 3 rupees. While on the other hand, there is something which is of 10 rupees, but you have 50 rupees in your pocket. And you are able to buy it because you have 40 rupees extra. So you have liquidity. There is flow of cash in your pocket. You have sufficient amount with you. You have sufficient rupees with you so that you can buy the thing. That is what is called liquidity. Liquidity is readily available. The important word here is available. Availability of things. A readily available cash that banks need to meet short-term business and financial needs or financial goals. So the availability of cash with the banks. If the bank has sufficient amount with them, then it is said that they have the liquidity with them. But if the banks do not have the sufficient amount with them, they are not able to lend it to others, then there is a problem of liquidity. And this is what is happening at present, that there is deficit of liquidity. Liquidity in banks are not present at the moment. So there are two conditions. First condition is when the banks are in deficit, and second is when the banks are in surplus. So what happens is, okay, like for example, there is RBI and on the other hand there are banks. So in a banking system, when the banking system is a net borrower from the RBI under LAF, that is the liquidity adjustment facility, will come to the LAF. First let us understand that what is deficit and surplus means. So when the banking system is borrowing from the RBI, this is RBI, this is banks, and the banks are borrowing from the RBI. Banks are taking money from the RBI. So what is this condition called? This is called that the system liquidity is said to be in deficit, because when will the banks take money from the RBI? When they do not have the required amount of money. So they will take money from the RBI. So in this case is called deficit, because banks are lacking in something, that is why they are taking from someone else. And when the banking system is a net lender to the RBI, when the banks are giving money to the RBI, banks are giving money to the RBI, then it is said to be surplus. Surplus. Okay, this is a very simple concept. See, like you can take your example also. Like for example, you want to buy something which is of 5 rupees and you have only 3 rupees and you do not you have the deficit of 2 rupees. So what will you do? You will take that 2 rupees from someone else. What is there that is called the deficit, because you have the deficit and you have to take money from someone else. That is why it is called deficit. And when you want to have a thing of 5 rupees and you have in your pocket 10 rupees, so you have 5 rupees surplus, so you can lend that 5 rupees to someone else also. That is why when you are lacking something, it is deficit. When you have surplus, then it is called surplus. When you have something in more quantity, then it is called surplus. So now let us talk about LAF, that is the liquidity adjustment facility. So LAF refers to the RBI's operation through which it injects or absorbs liquidity into or from the banking system. See, what does RBI do? These are banks and this is RBI. When the banks has too much of money, the RBI absorbs that money, because when there is too much of liquidity in the market, and when the banks do not have much money, then what does RBI do? RBI injects money into the banks or into the market. So that is called LAF, that is the liquidity adjustment facility. Liquidity means money. Adjustment is that RBI is adjusting the money. When it is more, they are absorbing it. When it is less, they are injecting it. So liquidity adjustment facility, and who facilitates it? It is the RBI which facilitates it. These are very simple things. You just have to go to the word, read the name of the word very carefully. LAF, liquidity adjustment facility. So if someone has the capability or the facility to be able to adjust the money or the cash into the market or into the banking system, and who is that person or who is that authority who is doing it? It is the RBI. So when RBI lends money to the banks, on which rate it lends money to the banks? That is the repo rate. And when RBI takes money from the banks, then that is reverse repo rate. See, these are very simple. Okay, this is RBI, this is banks. Banks need money from the RBI. So they will ask money from the RBI and RBI will give that money to the bank. But will the RBI gives it on free? No, they will not give it money to the bank on free. What will they do? They will, like for example, they will give money to banks 4% rate of interest. Then what is this rate of interest? This is what is the repo rate. This is repo rate that RBI will give money to the banks is on repo rate, and the exact opposite of it is reverse repo rate, when RBI takes money from the banks. This is a very simple concept. If you understand one, you will be able to understand the other one, because the other one is exact opposite of it. Now let us understand the latest RBI data. You do not have to remember all these digits. I am just telling you and just showing you to understand the situation. You do not have to remember all these things. The outstanding bank credit. What does outstanding bank credit means? Outstanding bank credit means when you owe some amount to someone else. So the outstanding bank credit is stood at rupees 124.58 lakh crore. That was on August 26, 2022. So this is the outstanding amount on August 26, 2022. So what happened was, and earlier this was 118.9 lakh crore. Okay. So on March 25, 2022, it was 118.9 lakh crore. So March 25, 2022, it was 118.9 lakh. While on August 26, 2022, it was 124.58 lakh. It means it has increased from 118, it has increased to 124. This increment is outstanding bank credit. It means the amount which the bank owes to someone else is increasing, and it has increased by 5.7 lakh crore. While on the other hand, the deposit growth is less than the outstanding bank credit, while it should be reversed. And this is the reason why there is a deficit which is being created in the Indian banking system, because the growth rate is less than the outstanding bank credit. The deposit growth rate is 3.21%, while the outstanding bank credit is 4.77%. This was the reasons that I told you. What are the reasons responsible for the deficit? Is one of the reasons, prominent reasons, was because the demand is more than what we are getting in the banks. The receipts are lesser than the expenditure, and this is the reason that the outstanding bank credit is more than the deposit growth. This is what is creating the problem. Now let us understand what tight liquidity condition means. Rise in the government security yields. This tight liquidity condition, what does this mean? Okay, tight liquidity condition means that when there is very less amount present with the banks, and banks do not have much liquidity with them, and they are not able to lend further because they do not have the surplus amount with them to lend, and that is why it is called the tight liquidity condition. Tight liquidity condition, because they have to manage the finances, or they have to manage the liquidity in a very proper way, because surplus is not present with them. So whatever is present, they have to deal with them. That is why tight liquidity condition. So what will happen with the customers? Will the customers will be at profit or will be at loss? So what will happen is there will be rise in the government security yields, and that will lead to a rise in the interest rates for consumers. See, what will happen is, who buys the government securities? Primary question should be this: who buys the government securities? It is the banks. The banks buy the government securities, and if the bank do not have the money with them, the proper money with them, they do not have surplus money, they do not have, they are already suffering from tight liquidity condition. So what will banks do not have surplus money with them? So will the banks be able to buy the government securities? No. When the banks do not have the money with them, then how will they buy the government securities? They will not be able to buy the government securities. And when banks will not be able to buy the government securities, who will buy the government securities? It means the demand of the government securities is very low. When the demand of the government securities is low, it means the price of the government securities will come down. And when the price of the government securities will come down, what will happen to the yield? Government security yield. When the price of the security comes down, the yield of the security increases. They have inverse relationship. The relationship between the government security yields and the government security price is inverse. When the price will increase, the yield will lower down, and when the yield will increase, the price will lower down. They will always have an inverse relation. I have already made a video on the government bond yields and government bond price relationship. You can go and watch that one also. And from exam perspective also, you have to remember that be it government bonds or be it government securities, the price and the yield will always have inverse relationship. So when the government security price will come down because of low demand, its yield will increase, and that is why there will be rise in the government security yields, and this will lead to the rise in the interest rates for the consumers. So consumers will get a better interest rates because of the lower price of the government securities and a better yield they will get. So consumers will be at a profit. Like for example, you can see that the 10-year government bond yield has increased to 7.23% on September 21 from 7.18% on August. So from 7.18% it has increased to 7.23%. Now let us understand that what can RBI do in a situation when there is deficit. So first the RBI will have to see what is the nature of the deficit. If the nature of the deficit is of temporary nature, then the RBI do not have to do anything because that thing will come back to normal. But if the nature of the deficit is not temporary and it is permanent in nature, then RBI will have to intervene in this situation. But at present, they will have to see that the nature of the liquidity situation, and if the liquidity deficit situation is temporary, then it is like fine, they do not have to intervene much in it because things will come back to normal. And if the deficit is largely on account of advance tax flow from the corporates, then they do not have to worry much because this is a regular phenomena which takes place. But even if the other factors are also there, then the RBI will have to intervene in this. But if it is a long term deficit in nature, then RBI will have to take measures to improve the liquidity situation in the system. Okay, for example, if there is tight liquidity system and deficit is there in the market, then what can the RBI do? Like imagine there are open market operations. So then the RBI will buy the securities from the market, because when RBI will buy securities, then it will put money into the market for buying those securities. When they will put money into the banks, then the money will be in the banks and the liquidity will be with the banks, while they will be able to buy the securities from the banks. These things will happen. And what will happen to the interest rates also? What will happen to the interest rates by the RBI if they want to increase the liquidity in the market? What will they do? It will increase the interest rates. So when they will increase the interest rate, the more money will come to the bank in the form of deposit, because they will get more interest rate on it. So instead of going out of the country, they will deposit the same money within the country. So these are few of the measures which the RBI can take when there is deficit in the market or deficit with the banks. Now let us come to a prelims MCQ, and you people need to tell me the answer in the comment section. And this is a previous year question of UPSC, and this has been asked in the 2022 UPSC prelims. And there are three statements. Consider the following statements. First statement says that the tight monetary policy of US Federal Reserve could lead to capital flight. This remained much in news. Second is the capital flight may increase the interest cost of firms with existing external commercial borrowings. And the third is the devaluation of domestic currency decreases the currency risk associated with external commercial borrowings. These three are the statements. You can read carefully and give the answer, and the codes are 1 and 2 only, 1 and 3 only, 2 and 3 only, 1, 2 and 3. And you people need to tell me the answer in the comment section. Very good question, I would say, when it comes to conceptual clarity. If you have the conceptual clarity, then only people would be able to solve this one. Now let us come to the last section, and this is the mains practice question. This says, under what circumstances tight monetary policy is adopted by the RBI? Demand of the question is what, and this is a 10-marker question. You can do your answer writing practice. So that's all for today. Thank you so much for watching. Till we meet next time, keep reading and keep writing.